We're talking about planning for the following year. So we were trying to identify all things that we need to do to prepare for a new year, from the aspect of sitting down and reflecting on the past to the aspect of using the past to inform the future and making sure that we correct the mistakes of the past. Because often if we don't look back, we fall into the risk of repeating the same mistakes. So that is not something we should do. We should learn from the past and move on and take advantage of opportunities that come along the way and take advantage of them from a perspective of having learned from the past and using the past as a tool that informs and improves our experience. A value determination. Sometimes we fall into the trap of trying to think that everything that we are doing is what we really value. And yet, tacitly, our actions really tell us what we actually value. So sit down and determine from your actions what you think is very valuable to you. There's nothing wrong with you having a different hierarchy of values to your partner or to your friends or to any other person. But also, you don't have to be stuck to your values, because values are often something that we acquire along the way, either from our parents or from people that we live with. But how do you know what your values are? One way you can identify what your values are is to look at how you spend your time. How you spend your time, if you were to sit down and identify what you actually did the whole week. How much time did you sleep? How much time did you spend with your children, your wife? How much time did you spend shopping? How much time did you spend playing soccer? How much time did you spend at church? Add all that time and categorize the time and see where do you spend most of your time. You can almost inevitably see what you actually value from how you spend your time, because people have time for things that they value. If you value something, you will have time for it. People don't have time for things they don't value. Anyone who loves soccer, I tell you, they will never miss a match. They will ask for an opportunity to be updated on what's happening with the match if they really love soccer, because that is important for them. So sometimes we think that we should be in business and making money, and yet our actions don't reflect that that's what is important to us. So value determination process helps us to identify what is important to us and what we are actually dedicated to. The second way of identifying what you value is how you spend your money. If you look at your budget and identify things that you consistently spend a lot of your money on, it means that you value those things. They are important to you. The mere fact that you're spending so much money does not necessarily mean that it is wrong, but it simply also means that you can't spend more money on, say, for example, investments. You can't invest more if you're spending more on accommodation, because financial resources are limited. It simply means you value better accommodation than more investment. After the analysis, if you feel that that isn't right what you want to do, you can then sit down and adjust. That becomes the action you need to take. But you have determined what you value by your conduct, by your actions. Because sometimes we don't have the time to do that analysis and see, why are we spending so much on accommodation? Is that really what we need in the long run? So there is a difference between what you're actually doing and what you need in the long run. So that requires a process of self-introspection, which can be done by looking at your budget. And whatever the outcome is, you don't have to beat yourself that you're spending so much on a particular thing that you don't think is important in the long run. It simply means that up to that point, that is how you view things. Perhaps you have inherited this value determination from your parents or from people you live with, and it might not be serving you in the long run. So you might then use that opportunity to change and start allocating less resources on accommodation, whether the accommodation is with the rented or is you're paying for the property you actually bought yourself. It's immaterial. The important thing is that you then find opportunity to reduce your expenditure and look at all options and see what you can do. You can then divert some of the extra resources that you're able to pull from there to investing. The outcome of the value determination was meant to conscientize us on the belief that what we need in real life is earning money, and yet our actions don't necessarily support that. So if we think we need to be investing more and our actions don't support investing, then perhaps we need to relook and say, no, perhaps we shouldn't really be focusing on investing. That's not important to us. If we think we should be investing, then perhaps we'd say, okay, we need to cut somewhere else so that we support this idea. So today, the focus is going to be on ways of investing in property that are available. Because sometimes we're not sure whether what we are doing is right, or we might have inherited a particular practice of doing things. For example, I grew up with my uncle who used to invest a lot in property, but he used to actually build properties himself and then rent them out. He would be involved in buying bricks, buying roof tiles, buying timber, and so on. So when I talk about property investment, that sticks in my mind. Nothing else comes. So every time I'm talking to people, I often find that I'm not alone in that way of doing things. There are ways of investing which are much more than that. So today I want to first start by going back to look at what is an investment portfolio. So basically, an investment portfolio is proportions by which you hold your assets. You might have shares, you might have investments in the form of buildings, or you might simply be keeping your money as in 30-day term deposits, which are almost nearly cash, because you can still go and get the money anyway. 3 months, you can still go and get it anyway. Obviously, they'll penalize you. If for only 3 months deposit, if you really want your money, they will just penalize. They don't give you the interest for breaching the contract. So that is considered cash. But today we want to focus just on better ways of investing in property. What other ways are there for you to invest in property? So that's what we want to look at now. So the first way that is common is if you have money, buy bricks and mortar, buy a stand, build. That's traditional. But another way that is not explored, which most people who are born overseas are always talking about to me, is doing a joint venture. They want to pool money together, buy a stand and build a business. What they mean business is actually an industrial property. They want to build an industrial property and rent it out. And then once they rent it out, whatever process they get from there, they will then distribute and share. Whether they fully understand the implications or not is not the subject of today, but people really talk about quite a lot. The third way is to invest in what we call real estate investment trusts. Real estate investment trusts are listed vehicles on the stock exchange. They are pretty much like companies. So a REIT basically pulls money from different people. There are others that are not listed. I prefer the ones that are listed. The ones that are listed tend to be scrutinized by the stock exchange, and ASIC tends to be on their back. So there is a lot more disclosure and there's more transparency on what they are doing compared to the ones that are unlisted. There are rules that follow and they govern how they should operate, how they should disclose information, how they should allow new members to join in. REITs are supposed to distribute dividends. They don't keep a lot of money, especially the ones that are listed. Every quarter, actually some distribute money. Most of them distribute money every quarter. They have to distribute the rent or profit that they have made to their members every quarter. The more you have put in there, the more you get back, and they are open about it. If you are unhappy with the way a REIT is being managed or the way they are doing things, you can sell your holding on the stock exchange because it's publicly traded, which means you get your money back and you move on, you go to a different REIT, or you can go and do something else. Whereas if it's an unlisted one, you have to find some people within the group to sell to, and they will have to bargain with you how much to buy, and you might not like the price, this and that. So that's kind of a very difficult process for people, especially if you want to move on and just forget about it. There's also another way of investing which you can use through corporate bonds. Corporate bonds tend to be bought by big companies, but however, there's a way of investing in corporate bonds which allows individuals to put money in corporate bonds. The focus here on this conversation is about property. So we're talking only of corporate bonds that are going to be in connection with investment in property, which could either be public property or private property. So who normally issues out those bonds? Big companies like Westpark, Qantas, Stockland, which is involved in construction. But corporate bonds are also not accessible to individuals because a corporate bond, each one is sold at 250,000 Australian dollars. But because of that, they've introduced a measure which allows an individual to buy a portion of the corporate bond with a minimum price of $100. So that sort of instrument, which they call XTB, Exchange Traded Bond. So instead of you buying a corporate bond which costs $250, they've introduced an XTB, which is actually an instrument which you get when you buy a portion of a treasury, a corporate bond. But this unit is called an XTB. That allows you to invest in property. I like people to invest in public property. Why? Because public property will always be paid for. I've never had a situation where public property was never paid for. So if you put your money in such properties, you will always get a portion of your rent without fail. And the increase is never negotiated and countered by a union as we normally see. Increases for public property, if they are agreed, they will automatically be increased and they will be paid for. And your money, your rent, your income also will also be increasing, because remember, once it's signed, you are guaranteed your money. I want us to remove the notion that we can only invest in property which is single housing units or flats for people to live in. No. That is not the only way we can invest in property. You don't necessarily need only to build a house where you're going to be dealing with tenants, running around with best pipes and geysers and so on. So that is not the only way to invest in property. There is another way, which is equally competent, which is investing in public properties. But at an individual level, you don't buy them as corporate bonds. You buy them as XTB, as exchange-traded bonds. But notice something that is very important, which is if you bought an XTB and there's a face value of $100, it will never drop to $50 like shares. It will retain its value. If you agreed that the interest is going to be 5% at the time you buy it, it will always be 5% until it matures. So in the instance of where interest rates are 0.5, most XTBs are about maybe 3.5 if you bought them recently. That's probably the minimum, but some XTBs, like maybe the Qantas one, is almost up to 7%. In addition to having stability, when you think of buying an XTB, XTBs are sold roughly for about 5 years. Having said that, if you buy the listed ones, they are traded on the stock exchange. If you don't want them anymore, if you are hard pressed for cash, you can sell them, or you can sell a portion of them, which gives you the advantage of share. But the beauty is still that you don't lose the portion of capital. They will never go below the value you bought them, because the person who buys them buys the right to receive the interest that you were receiving from that point you buy them going forward. So it's a very important instrument to think about whenever you're talking about investing in property. I'm talking about XTBs that are property related. That's why I brought this in the context of property. There are other XTBs that are not property. I'm focusing on property. The advantage of this is that they are defensive in the sense that they don't have their price going down, especially in times of unpredictability like the coronavirus period. People who were holding XTBs, they never felt anything. Their interest was going to be paid and was paid. There was no story about it. Their interest never went down because the Reserve Bank reduced rates. No, if they bought those XTBs last year or even during the coronavirus, whatever rate they were being offered at the time they bought them is still what they are getting. So some people actually benefited. Imagine when actually shares were going down and the people who had XTBs were getting a high interest. That means they used that money to buy even shares. Most XTBs, some pay quarterly, some pay half yearly, some pay yearly. So you choose depending on how you want to structure your cash flow. The day-to-day change in the market conditions don't affect XTBs. They are similar to term deposits, but they are slightly different to term deposits in the sense that term deposits tends to be very low interest generally. They tend to pitch themselves higher than term deposits. So they have better rates than term deposits. Obviously, they are much safer than shares. Yeah, the general rule for XTBs is buy and hold. You are not buying to trade. They are not instruments you can buy and trade like you can do shares and make a profit easily. They are meant for people who are putting money to invest for a long term. So how do they compare with other investments? So the most secure in the ranking for financial instruments is government bonds. That's the most secure, sort of like the bottom line. So as a fixed income investment, XTBs play a very defensive role in your investment. The underlying bond for XTBs are generally issued by the ASX. So the underlying bond is usually the corporate bond, which is issued in the ASX. So if you want something which is better than term deposits, which is also equivalent to investing in real property, consider investing through XTBs because XTBs saves you a lot of hassle, which you would normally get if you actually have to build a house, organize builders, buy material, repair, find tenants, advertise for tenants, and so on and so forth. They are generally very efficient because their management or their return will all the terms of the XTB, they are known in advance. So there's no surprises for you. You're not going to start wondering, okay, why is it that I don't have income this month? XTBs, the money comes. If Transurban wants to do the road and they say they need money from you, they will pay you every 6 months, the money will come. If it's 7%, it will be 7%. They are still much better than term deposits. Even when you diversify in property, consider diversifying within the same asset class of property. Put a bit of it in residential property, industrial property, and public infrastructure. We have this mentality that investment in property is stable. I think the coronavirus pandemic has proved us wrong. That investment in property itself, rental property specifically, is not very stable. It can be hit by other things, and we have seen what those other things are. All you need to do to manage your risk when you're dealing with XTB is look at the firm that is offering them. Try to pick the XTBs that are offered by bigger organizations. Normally, they sell XTBs which are only offered by the S&P 200 firms, the big firms in Australia. They are relatively very secure, and but obviously you need to choose based on your circumstances. Some are shorter term, some are 7 years, some are 10 years, some are 15, some are 20, and so on and so forth. So you will choose depending on what you want to do with your cash flow. My point here, in conclusion, is let's not confine ourselves to investing in rental properties and put ourselves at risk of losing our money or losing income in any one particular month when the tenant doesn't pay, or when we don't have a tenant, or when we need to repair something significant and as a result we can't have a tenant. Most times when you have a rental property, what actually happens is that when the tenant moves out, you need a week or so to actually fix the property. You technically are losing money. Well and good if you have an interest in rental property. Do consider diversifying within the same asset class, going to joint ventures with others, or buy a REIT, real estate investment trust, which is sold like a share. If you don't like the share-like nature of a REIT, you might want to buy an XTB. XTB combines the aspect of a share in the form of tradability. In other words, you can buy and sell it on the stock exchange, and also the aspect of a term deposit, which is the fixed nature of your interest. It's agreed in advance, stable, and it's paid